I think it's really important to keep the recent pullback in the markets in perspective. As I said off the top of the show, I've received a lot of calls, a lot of nervous investors. Some investors telling me, we have never seen something like this before where the market has fallen for this long or this sharply. I heard some investors wanting to sell out of the market and move into some fixed income, more fixed income, or sell completely out of the market and just wait on the sidelines for better days ahead. And as I always say on this show, I'm not a fan of that approach. I'm not a fan of that type of management. You can never time markets. By the time you figure out the coast is clear to get back into the market, you probably would miss out on a significant amount of gains, whether it's 20%, 25%. These gains happen very quickly. And we all know that if you miss the best, 10 or so days in the market over a period of time, your returns are significantly reduced over that period. And so, for you to make and to outperform, make money and outperform over the long term, you need to be in this market for those good days. And because we don't know when those big up days happen, unfortunately, you're going to have to be in there for the bad times as well. And what we do know is some of the biggest rises or surges in the market tend to happen right after the market declines. So very difficult to time markets, and definitely not a strategy I would recommend or use. We're going to show you some charts right now, and these charts will clearly show you that the decline that we had this year, now I mean this year from Jan 1 to present day, of roughly about 5% on the S&P, TSX, Toronto Stock Exchange, roughly flat on the year. And then you have the NASDAQ down a little bit more, in and around, let's call it, 7-8% on the year, so a little bit more. Not as bad as seeing a 10% decline from the highs or 13% declines from the NASDAQ from the highs. And I think individual investors get confused when we talk about declines for the year and declines from the all-time high. Perhaps the all-time high was too high to begin with. Maybe the market should never have gotten that high. And so they're giving back a little bit of the gains right now. And I think that is the case. And I am confident that we're going to see these markets surge higher down the road. So our first chart shows you the S&P 500. It's going to show you how the market has fared on the right-hand side since about mid-February to present day. You can see a bit of a blip up on the right-hand side. That's the S&P 500. And that will show you that the market's down coming into today. I know the market's higher today, in and around 5%, give or take a little bit. Our next chart here will show you basically a 1-year chart. And you can see here, and we're going to magnify the certain points in the last year. But if you look at the April time period, you will notice that there was a decline last year, a pretty big one, 4% decline in April of 2024. So even though we saw gains of 20+% on the S&P, we had declines in April of 4%, so negative 4%. If you fast forward to August, which is the next blip down there, you will see that in August, we actually lost 6%, a 6% decline in the first few days of trading. So the first week of trading, the market dropped 6%. Putting that in perspective, in the last, let's call it 5 weeks, the S&P 500 has lost 5%. So which is worse? Well, I think the decline last August was definitely worse. Much more sharp, quick, sharp decline, which is somewhat what we're seeing now. But look at what happened after that. The market continued to roll higher, and we ended off making over 20% return. Our next chart actually is a great illustration of comparing what's going on this year. So on the far right-hand side, that is the decline this year from about February to where we are today, third week of March or so. But if you go all the way to the left, that is the decline that we saw in August. The decline of the line down is much more steep versus slightly less steep in the March. And then you could also see there was a decline in September. We saw one. In November, we saw one, which were definitely not as steep as August or the one we're experiencing now. So even in a good year, we do see declines in the market. Usually you see 1 or 2 declines. And as I say often on our show, over a 5-year period, you see 1 correction or so. Over a 10-year period, you might have 2 or 3 years of negative markets. But on average, you're going to see about 7 or 8 positive years. Our next chart here, the S&P 500. This magnifies or shows us kind of a zoomed out or zoomed in, I should say, perspective on April of last year. You can see the fall towards the left side before we got to May, and then May was a fantastic month. And our next chart here, which is our last chart for this segment, and it zooms in on the August decline, our last S&P chart there. You'll see there it is, the August decline. You can see just in the first few days, a pretty sharp decline on the far left of that chart. So what does this show us? Well, ultimately, as investors, you can never really get too high, you can never really get too low. You got to stay even keel. You want to take emotion out of the markets as best as you can. And unfortunately, with what's been going on with respect to tariffs, trade wars, interest rates, inflation, President Trump and what he's been saying and how he's been talking about Canada as the 51st state and all of that, I think it's really stirred up a lot of emotion from Canadians, from investors on both sides of the border. A lot of people are unhappy with what has been said and how things have worked out so far. But you can't let that affect what you do with your investments. You can't let that affect your portfolio and what your ideas are, and to continue to look for good quality even in difficult markets. So as I've shown, even in a downturn as we're experiencing now, it is not the first one. It is not one that we haven't seen before. We actually saw downturns last year that were worse in a very short period of time, like we saw in August. So 5% decline in the markets, I don't want to say is expected because we never like to expect it, but it definitely happens. And going forward, I think you should expect more corrections in the market. Hopefully, we get a bit of a bounce back here, maybe come April, which historically is a good month in the markets. We're also going to get perhaps some certainty on some tariffs, reciprocal tariffs that perhaps will be announced at the beginning of April, which, yes, may not be that positive, but at least it'll give us some certainty. And as we know, markets like certainty. So I look forward to, as I said off the top or the start of the year, a positive year. I think we just got to get through these difficult times to get to the other side before we experience a year that I think will still be in and around 8 to 10% growth on the S&P 500.